stock market and some real estate markets too. Put them back together so that they make sense for you. I'm Forbes Markets Editor John Dobis, joined today by Brad Thomas, a Forbes contributor. You probably know the guy if you read the magazine or if you read online here. He did REIT innovators, 3 REIT innovators with strong yields. Nice Thomas Edison picture. Brad, good to have you on board here.
Thanks to be here.
All right. Well, I mean, so real estate investment trust, basically this is giving money to guys who know what to do with it in terms of development, right?
Right.
Fundamentally. And they have to pay out 90% of income is
90% of dividend out of FFO, funds from operation.
So the last 10 years, first part of the decade, REITs were going to town. And then, of course, 2008 came along and you had the big crash and everything. Stocks, real estate was hit hard. Kind of bottomed around November of 2008. This is a chart for that almost 3.5-year period. This is the ICF. It's an ETF that tracks a lot of the biggest REITs, Cohen and Steers, up 139%. That beats everything, gold included, over that time frame. So REITs have come back strongly. One big thing down there is they had some big fat yields. Yields are kind of down now though, right?
Well, they are down, but they're coming back out, and I think you're seeing a lot of the dividends start to build back up again, and you're seeing a lot of the activity in all the sectors, quite frankly.
One of the stocks, one of the REITs that you pointed out in your article, ticker symbol is O, kind of like the big O right there, of course, Oprah the Great, but Realty Income Trust. People think like you do. They love it. This thing is just got a full head of steam, going from 32 to 39 bucks. Nice little run in the last just 4 months.
Absolutely, very sustainable business model here, and 2,600 properties in 49 states.
What kind do they own?
All types, really. What you see on every corner, every street corner. You see fast food, you see auto parts, you see drugstores. A very diversified.
It's like a retailers more.
It's actually retail, but it's gravitated into other asset categories. Coca-Cola, FedEx,
right.
Caterpillar. So it's very high quality income related to this business model.
Cool. Another one you like? You're really digging Kim, Lil Kim or Kim Kardashian. Take your pick.
Like them both.
No, yeah, they're great ladies. But no, the ticker symbol KIM, Kimco Realty. Kimco, what do these guys do?
Kimco is the largest shopping center REIT in the land. They operate over 900 shopping centers in the U.S., Mexico, Canada. They have a very sustainable business model. They're landlords for companies like Home Depot,
right,
and Walmart.
Big national tenants, kicking out a 4% yield. And Kim, don't forget Lil Kim's kicking out a 4.5% yield. Storage Wars, big A&E show. People bid money to get into the lockers people have left behind. A lot of funny stuff. Companies in that space, though, are going crazy, right? Public storage.
Absolutely.
And Extra Space is your guy.
Exactly. The self-storage industry is highly fragmented, which means there's a lot of growth opportunity within that sector. In fact, last year, this company, Extra Space, had a total return of around 45%. So
well, the stock's been on fire here. It's going from 19 to 29 since October. That's in a real estate investment trust. That's pretty smoking. It's 50% almost in just 4 months, 5 months.
Absolutely, and the diversification represents a huge margin of safety in this portfolio.
Yields down to 2.8% because the stock has gone through the roof. But you think more to come. And then we're hitting the outlets. Let's go get a nice Tommy Hilfiger sweater or some Timberland shoes that fall apart the next day. Anyway, we're hitting the outlets here with Tanger.
Right, Tanger, another great growth story. I mean, this company has been around a long time. They've been paying dividends for 18 or 19 years. I call them dividend champions. But a lot of growth in this sector. There's a lot of markets that don't have these discount centers, which is what Tanger's.
So this is what they have, right? The Ralph Lauren and the Bass and all that stuff, and,
right.
and Gap, and they own a bunch of them. And they too are going not at the pace that Extra Space Storage is higher, but they're hitting it nicely out of the park. One thing I want to bring up: interest rates. This is going back to President Kennedy, 1962. The yield of the 10-year Treasury peaked out at 15% in 1981. Been going down since then. You got to think it might be going back up sometime. Don't higher rates hurt REITs?
Certainly, the interest rates will certainly impact the mortgage REITs more significantly, I think, than the equity REITs. Because you got to understand, the equity REITs, most of these REITs have fairly conservative balance sheets. They've made it through this last huge Great Recession period. So I don't look for
big Darwinian process you saying went on.
Survival of the fittest, absolutely.
Right. Cool.
Absolutely.
So yields are down, but the stocks still have momentum. And if the recovery goes, these REITs keep going higher?
I think they're going to keep going on. And definitely I would recommend a large allocation in this sector.
Check out Brad's columns on Forbes.com.